Hello and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Lavinka. Today we're going to be talking to you about credit. There's a lot to talk about in this episode, so we're going to try to get as much information to you as possible. Mandy, do you want to introduce a little bit about credit and how we look at it and get started with it?
Absolutely. Yeah, credit is definitely that mystery beast when it comes to mortgage lending, and generally what people, besides of course finding the house, generally what people are the most nervous about. When you come into the mortgage company and or fill out a loan application, one of the first things we're going to do is we're going to pull credit, and we do have the ability to do a soft pull. And a soft credit pull means that we're not going to be it's not going to be a hard hit on a credit, so it's not going to affect your credit scores, but it's going to give us the information that we need to start working on how much you're going to qualify for. When we pull credit and we do a hard hit on your credit report, a couple things happen. One, it generally will be about a 5-point hit on your credit score, which if you have amazing credit, excellent credit, high sevens, things like that, a 5 points hit isn't going to affect you much on your credit. But if you're someone that's watching your credit and trying to improve your credit, that can definitely factor into things. So again, that's where we kind of want to talk about, should we do a hard hit on your credit? Should we do a soft hit? When we do the hard hit on your credit, that's when things get a little complicated for you as the borrower, because there are things called trigger leads, and basically people on the backside, the credit agencies that are pulling the credit and everything, can turn around and sell your information to other creditors, and they will then be reaching out to you. And sometimes it can get really confusing, especially when you've started working with us, a lender, and then we've pulled your credit, and now you've got 10, 15, 20 other people calling you, texting you, emailing you, sending out a fire signal to please call me, and so it does get confusing.
And sadly, we can't do anything about that. It's not something that we have any control over.
Yeah, it should be illegal, but it's not. So, but there are ways of getting out of it, and you can do what's called opting out. You can Google opting out. We have we can give you the information for opting out. You can do it by phone. You can do it by email. You can do it by fax, although I'm not sure who's faxing anymore. But you have lots of options. And opting out, it does only last for 1 year, but by opting out, it will eliminate having a lot of these phone calls, emails, texts, things like that. And we actually try to encourage you to opt out as soon as possible, just to avoid a lot of this, because when you close on a loan, it is public notice, and you'll receive more information from a lot of other companies as well. So to help avoid a lot of the spam, you can use the opt out, and that will help that.
So the next thing is what do we really look at? In mortgage world, we do what's called a tri-merge report. There are three major credit reporting agencies in the U.S., Experian, Equifax, and TransUnion, and we will get a report from each one of them. We will then get rid of the top score and get rid of the lowest score, and we'll use what's called the mid score. So that is what we will base our lending off of. So don't worry if you have one that's lower than the other. We'll use the middle score there. Now, how credit scores are calculated on a mortgage level versus a consumer loan level is a little bit different. You may notice when we pull your credit, the score that we give you may not match what you're going to see online. And that's because for a mortgage credit report, it's a little bit more thorough, and ultimately, for whatever reason, we see lower scores. That is okay, so don't worry about that. But what goes into scores is a lot. Late payments, how many accounts you have, the length of the accounts you've had, the balances that you have on those accounts. But the best thing to improve credit is really time and paying your bills on time. That is just super, super important, because when you go into the mortgage transaction, we would rather you have the best score possible. We'd rather have more options, and so protect your credit at all costs.
Absolutely. Having good credit is means everything in any kind of business, but obviously definitely when you're talking about mortgage lending. So the better the credit scores, the better the fees, the rates, private mortgage insurance. There's lots of things that can affect that. And like Connor said, making sure that you're making your payments on time, obviously super important. But there's a lot of people out there that make their payments on time, but they are super stretched out with credit. And that can also really bring your credit score down as well. So making sure that you're not maxing out credit cards, especially if you're maxing out several credit cards at one time, that can be a problem. You really want to not use more than 30% of whatever your credit limit is at any given time. A credit card can help your credit score tremendously, especially if you're paying it on time and not using more than that 30%. But a credit card can also hurt you tremendously. If you are maxing out credit cards every month on a monthly basis, and I'm talking several of these cards as well, it can really start affecting your credit score.
Ultimately, credit, another word that can be used for it is risk. Everything about credit just comes down to risk. Like Mandy said, if someone extends you a credit line and you're using all of it, you are a higher risk. If someone extends you credit and you're not paying them back on time, you are now a riskier borrower. If you are going and opening up lots of new accounts, that's why Mandy said that there is a 5-point deduction on your credit. If you go all around town and open up new accounts, you have the potential and the risk to charge up a lot of debt very quickly. And so that is going to make you riskier looking to a potential creditor.
Absolutely. And I do want to add one caveat to what Connor said about having your credit pulled a lot. They do allow, if you're mortgage shopping or car shopping, you can have your credit pulled and for one time and it hit your credit score at that first time hit, but then you can shop several mortgage companies and it not affect your credit score in that 30-day period of time. So they do allow you to shop around. So that is nice that it's not going to be hit every time. But it's important, like Connor said, to not be going and having a ton of credit cards, having those opened up. When we pull your credit, we can see who's checked your credit in the last 120 days. And we're going to ask you, did any of these accounts open up that aren't showing up on your credit report and everything too? Sometimes when you open a new account, especially like a new credit card or a new car loan, it can drop your credit score at first by about 20 to 25 points, not including the hit that was just when you had the credit pulled. So keep that in mind, especially if you are thinking about buying a home sooner than later. Don't be out. Avoid shopping for a new vehicle. Avoid having your credit pulled a ton because those credit inquiries can also bring your score down as well.
One trend we wanted to discuss is the adding of self-reported trade lines to your credit account. We're seeing more of that happening now, and what that means is there are certain things that are automatically going to go there: a car loan, a credit card, mortgages, and stuff like that. But your electric bill, your trash bill and stuff, that's not going to be reported to credit. And we're starting to see a trend of that being self-reported to try to boost your credit. And in some realms, in some loans, that may help. In the mortgage world, that actually hurts. We actually have to have you remove those. So I guess don't fall into the trap of adding those to your credit thinking that it will boost it, because unfortunately it will not. And finally, to kind of summarize, when we're looking at your credit, believe it or not, the biggest thing we're looking at is your monthly obligations. So say you owe $2,000 on a credit card, but your monthly payment is $37. The $37 is actually what we are going to hold against you as a monthly debt. So that's a little bit of a misnomer. So don't worry about the balance. We're looking more at that minimum monthly payment.
Absolutely. And a lot of times we have clients say, but I pay $500 a month or I pay it off every month. And that's fantastic. That's great. But we only have to count the minimum monthly payment that is being reported towards qualifying, which is a good thing for you. That's good. We, if we have to use your $500 a month that you choose to pay, but that's not the actual, then that's going to affect what you qualify for. And back to what Connor was saying on the self-reporting, that's the same issue also, is if you're adding more debts that don't need to be on your credit report, in a way you're just hurting what you're actually going to qualify for as well.
Exactly. We really appreciate you joining us. We have so much more to talk about with credit, but we don't want to keep you too long for today. We'll talk more about it in future episodes. And again, thank you so much for joining us. We'll see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196 576, and 1820404. Equal housing lender.